Hey Captain, welcome to Captain Finance, where we empower you to achieve financial independence in 10 years or less. In today's video, I want to look at mortgages, specifically homes that you want to buy through bank financing. So you've been thinking about buying a home. You've been looking at all the categories on Instagram that you can see, and you've chosen one that you want to buy. So should you take a mortgage on it, especially that in Nairobi, we're getting houses where you can take it as a mortgage or you can even rent the very same property. So let's have a look. Now, I'll show you 3 different properties. 2 of them will mainly be for renting to live in or mortgaging to live in, and 1 of them can be an investment property. And I'm showing you how you should be thinking about it. So without further ado, let's jump onto the first one. So here we are on the first one. This is on Kiambu Road. I think this is Edenville too. And what we're looking at is properties that are around 25 million. Now, I'll show you also how to calculate mortgages in a second. But just what I need you to notice is how much they're giving it for. They're giving a 4-bedroom house with a servant's quarter for about 100,000 Kenya shillings a month. While if you were to buy it, you'd buy it for about 25 million. So is this a good place to put your money if you want to take a mortgage? Let's see what the Excel has to say. Okay, now that we're on Excel, go to a new sheet, right click. Typically, you'll end up on general, hit spreadsheet solutions, loan amortization. Just give it a sec. So here we are. We've been told that the property is 25 million shillings. So just input 25 million. 1, 2, 3. Let's assume the interest rate will be about 12%. The period will be around 20 years. That's what you can get on most of the international banks. And then you're paying 12 times a year. So what's the mortgage that you'll be calculating for yourself? About 275,000, 175,000 more than the rent of the property. So all it means in this case is that it's cheaper for you to rent the property than to mortgage it. Let's look at a cheaper priced property in Kilimani to see if the numbers still make the same difference. So here we are. This is one that's in Kilimani. The house is going for 12 million. And if you were to rent it out, you'd rent it out for 80,000. So it's a 2-bedroom with a servant's quarter. So let's look at the numbers and see if they make sense. So we'll go through the same exact process: insert, loan amortization. Now we've been told that the property is 12 million shillings. So we input 12 million, 1, 2, 3. We're still paying 12%. We're doing it for 20 years, paying 12 times a year. So what level of mortgage are we paying? We're paying 132,000. 52,000 shillings more than if we rented the same property. Property is going for 80,000, mortgage is going for 132,000. So in this sense, it will be cheaper for you to rent the property than mortgage it. So let's look at one more example. This is a property in Syokimau, and from my perspective, or from my view of it, it looks more like an investment more than somewhere you're going to live. But since this video is about mortgaging to live in, let's just look at it that way. So the property itself is valued at 3.5 and its rent is around 35,000. So what do the numbers have to say? So this is the final property that we're looking at. It's 3.5 million, paying 12% per annum for 20 years, and we're paying 12 times a year. So as you can see, this is really close to the rent that we'll be paying. So of the 3 properties, this would be the most reasonable. But you're not on this channel for reasonable. and most likely you want one of the two above, or the property that you're looking at is closer to the ranges that we've seen in the other two properties. So if you are to afford the earlier properties, what do you need to do? So what do the numbers mean? We've seen three different properties. Two of them, you keep more money in your pocket if you rent. And one of them, mortgage, sort of makes sense. So if you were to take the first two, the one in Edenville and the one in Kilimani, what would you need to do to live there? So this is my advice, and advice that I'm taking, advice that I'm executing. If you live in a place where the mortgage is more than your rent, rent where you live, and then take that difference, invest it, put it in something relatively low risk. Again, this is your choice. If you're a high risk individual like I am, you can put it in high yielding investments that probably can blow your account or multiply it several times. That's your choice. But these are the steps. First, before you move into any place, or even if where you live right now, find out, especially if you're renting, find out what the mortgage for that place would be. If in the first example, it was 275,000, that was a mortgage, but the rent is 100,000. What you do is take the extra 175,000, put it in something that is secure, a money market fund, a T-bill, a bond, any of those, and continuously put it every single month. So the idea is, if you take the difference and you invest it, you'll be sitting at a better place. Now, let's look at a specific example. The first example, if you were to put aside the extra 175,000 a month, where will you be sitting 20 years down the line? So let's do the math for the extra 175 that now belongs to you and should be working very hard for you. So we take the 175, put it in a conservative investment that makes you around 10%. Right now, you can get several unit trusts that can give you that. You can probably put it in a bond if you like, wherever you plan to put it. That is your choice. Talk to your financial advisor on that. So we're putting it at 10%. We're putting it continuously for the next 20 years. So we put an extra 175 every month. And then, since we know inflation is a silent, I guess, killer, we hedge for inflation by putting in 6% extra every year. Now, what does that translate to after 20 years? After 20 years, you'd be sitting on a pot of about 205. So you've gotten the utility of living in your house. And then on the side, you have an extra 205 million shillings to put into whatever other project or whatever other real estate you want at the time. If you've lived in your house for 20 years, you've probably allowed your kids to grow, they've gone to uni, and now it's just you and your wife, or you and your husband, and you're thinking, what next? We need to get a smaller house, we need to travel, we need to do whatever the hell we want to do. This pot gets you there. So all I'm trying to do is show you a different way of thinking about ownership. If to you, the title of I own my house is more important than having an extra 205 in your pocket, then that's okay. That's a choice. If on the other hand, you do not mind not owning where you live, but instead investing the difference. See, first of all, that gives you freedom to live anywhere in Nairobi, anywhere in Kenya, probably anywhere in the world, and do the same thing. Second, it allows you to have a nest egg specifically related to your living. that now you can put in 20 years later and decide where you want to allocate it. It's your choice, it's your money. So I need you to not look at taking a mortgage as the smartest investment you will ever make. Because first of all, anything that you invest in needs to pay you. If you take rent and invest the difference between your rent and your mortgage, then at that point, you're basically paying yourself to live where you live. So consider that. I'm not saying that you do it, I'm just saying consider that. I hope this video brought you value. If you like it, please like, share with a friend that is considering to buy a house. And until the next one, have a brilliant one.